I wasn't going to make this video, but I discovered this $4.79 stock, and it's literally powering the next generation of cancer treatment. So it's literally the thing that's, curing cancer. And Wall Street, well, even Wall Street's discovered it, and it actually has a significantly higher price target. But the real thing is that this company just had its best quarter for one of its revenue streams in its entire history. And most retail investors like you and me, we've never even heard of it. So we're talking about a company sitting on over $260 million in cash, no debt, in an industry that's growing exponentially. So to me, this is one of, if not the biggest infrastructure play in healthcare. And by the end of this video, you'd understand why flow cytometry, that industry is exploding, and why this stock called Cytek Biosciences is positioned to capitalize on it, and whether this beaten down stocks deserves a spot in your portfolio. My name is Felix Prehn. I'm an ex-investment banker who's seen how Wall Street really works from the inside. I know how the game is played. I know how the research reports are written, and I know when retail investors are being left out of opportunities. I'm also the founder of the Goat Academy with over 20,000 students learning how to invest like the pros, and the co-founder of TradeVision.io, because my mission is simple. I want to democratize the Wall Street knowledge and give everyday investors the same tools and research that the big players use. And it's for that same reason that I'm going to run a live training on how to find and pick these stocks on your own this very Saturday. I believe it's at 9 a.m. New York time, which is about 2 p.m. London time, so you Europeans and Brits can show up for it as well. And you can register for that at felixfriends.org/training. It's completely free. It'll probably go for 90 minutes, maybe even a little longer. But let's get back to this stock. Now, this is a stock that's too small for most fund managers to care about. But it is big enough to potentially deliver serious returns if you understand what you're looking at. And I want to be very clear on this. I'm not telling you to run out and buy this stock. I'm not giving you a single stock tip here so you can make some money. And what I'm doing instead, and I know some people are going to leave the video because I'm saying that, that's okay. I want to show you the process. I want to show you what I'm looking at so that you can make smarter decisions going forward. But with this one here, this is a biotech stock. You've got to be aware of the risks, and we're going to cover a lot of the risks here in this video today. So please make sure you watch this to the end. Otherwise, you'll have half the information, and that could be quite dangerous. So what are we doing here? So let me break down this company. It operates in an industry that most people don't even know exists. But every single breakthrough cancer drug, every personalized medicine treatment, every immunotherapy that saves lives depends on the technology these guys provide. So if you're afraid of deep research, run. We're going to go deep on Cytek Biosciences. The ticker symbol is CTKB. So first you need to understand why the industry is booming. That's always start in the industry. Flow cytometry is literally exploding. Now, what the heck is it? Flow cytometry is basically a technology that lets scientists analyze cells one at a time at incredibly high speeds. Think of it like a super-powered microscope that can look at thousands of cells per second and tell you exactly what's going on with each one. Why does it matter? Because understanding cells is the foundation of modern medicine. Drug development, testing, how do those drugs affect cells, immune system, and so on. That's what you need to understand. So if it's a blood disorder, leukemia, lymphoma, every major drug company, every university, every research lab, every major hospital, they all need this tech. It's not optional. It is critical infrastructure for the health sector. Now, here is where it gets interesting. This is what caught my attention first for us as an investor. It's in some niche little market. The flow cytometry market alone is worth about $6 billion right now. In just 5 years from now, it's expected to grow to possibly $10 billion. There are a bunch of different research firms that put out this kind of data, Grandview Research, Mordo Intelligence, markets and so on. But that's just the flow cytometry specifically. The broader life sciences tool markets, we're talking 170 billion growing to potentially 300 billion. So these are not my numbers. These are from the top market research firms in the world. So this is happening. So why is this market exploding? Well, there are 5 drivers. One, cancer treatment is being revolutionized. So there are 1.9 million new cancer cases diagnosed in the US every year, which is absolutely shocking. One of the reasons, by the way, I'm in this beautiful resort here, which is it's a health place where you prevent these things. This is what this is all about, but that's a different story for another day. But the way we treat cancer is basically changing. We are not just doing chemo anymore, we're doing immunotherapy, CAR-T cell therapy, personalized treatments based on your specific issue. And guess what? Every single one of these treatments requires flow cytometry to develop, to manufacture, and to monitor the patients. Driver number 2 is personalized medicine. Medicine is moving away from the, here's a pill that works for everybody. It's now moving to, let's test your biology, give you the exact treatment that works for you. It's more sophisticated, and guess the kind of tools they need for it. Yeah, this is the one. Number 3, pharma R&D spend. Pharma companies, this is huge. They're spending insane amounts on R&D. Just the venture capital funding for biotech is $146 billion this year. FDA approvals, last year it was like 16 for this stuff. Now the NIH alone spent $47 billion on research this year, and as I said, the VCs another 146, and the approvals from the FDA have almost doubled year on year. So every single one of these projects requires flow cytometry. And then we have on the 4th, which is AI. Yeah, AI is a big part of this too. Labs now want automated, intelligent systems that can analyze thousands of samples without human error. What are they using to analyze those? Yeah, you guessed it, cytometry. And what that creates is a base effect. Once a lab buys one of these flow cytometry machines, which are not cheap, they're like $200,000 to $500,000 each, they're locked in. They need reagents, they need maintenance contracts, they need software, they need consumables. It's recurring revenue, and it's growing faster than the equipment sales. So let's come back to you. Why should you care? You're still here. You're like, what's he talking about? Well, if you're a US investor right now, here's why you should care specifically. North America dominates this market, 40% of the global market share. There's a Boston, San Francisco, San Diego research triangle. And it's American companies that make these tools. They have a massive competitive advantage. There's a very, very high switching cost here, which is basically a moat, which means once you buy a piece of equipment that's $500,000, you're not going to run out and buy someone other companies, right? You're going to stick with that company because you're now basically locked in. And the beautiful thing is, if the economy tanks, a lot of people are worried about that, people don't stop developing cancer drugs. Pharma R&D continues. So this is not discretionary spending. We're not going to go to Dollar General on research. And if you look at 2008, 2020, these life sciences tool companies, they held up better than most sectors. So when the market crashes, this sector is actually very resilient. So now you understand the industry, right? You got that down. It's big, it's growing, it's backed by massive government and private funding, and it's critical to every major medical breakthrough happening right now. So then the question I always ask is, which company in this space is positioned to potentially win? And just for transparency, and I want to be very clear here, I'm not promising returns, I'm not promising you that this will necessarily be a winner. There is a bit of randomness in the market, but I'm explaining to you the process of how I picked this. But if you just look at our stock picks for September, these are just the ones that I put out on YouTube. Right? You see these ones here. So we had an average gain in September on these of 24%. And that includes this one here down 18%, which if you had some risk management, you might not have had such a bad drawdown. So I'm not saying that everything we pick is always going to win. I'm just saying we do have some wins. That's what I'm saying here, right? So just a bit of frankness here. I didn't cherry pick these, by the way. You can go back on the videos. I put them all out. I included every single stock we mentioned there in that. Now, of course, for my students, we have a much, much longer list than just a few that we put out on YouTube. And it's because we're process driven. It's always a process. It's never like, oh, let's find the needle in the haystack. It's always the same process. If you want to learn that process, it's the process I learned from my mentors. It's what guys on Wall Street have been using for 50 years. Then come and join me on Saturday for free at felixprehn.org/training, and I'll teach you. That's at 9 a.m. New York time or 2 p.m. London time, 3 p.m. I guess continental time. So let's get a little bit deeper into this actual company. You understand what flow cytometry is and that the industry is actually booming. So ticker symbol again, CTKB, write that down. Trading at $4.79 as I'm recording this. The company's been around since 1992, about 30 years. They went public in 2021. And what I really like is they have $260 million on hand in cash, zero debt. Right? So that's kind of what we look for. So what do? Well, guess what? They make flow cytometry machines and all the stuff that goes with them, reagents, software, services, and so on. But there's one thing that makes them different. They have a proprietary technology called full spectrum profiling. So stay with me here because this is where it gets good. Traditional flow cytometry can analyze maybe 10 to 15 different markers on a cell at once. So looking at cells with 15 different colors. Cytek's full spectrum profiling technology can analyze 30 to 40 different markers simultaneously. So it captures the entire spectrum of light from each cell. So think of it like this. Traditional flow cytometry is like having 15 crayons. Cytek technology is like having 40 crayons, right? You can see way more detail, you can get way more information from the same sample. And for researchers, that's a game changer. They can run one experiment instead of 5. They can find rare cells that traditional systems miss, and it saves time, it saves money, it enables discoveries that weren't possible before, and it's all about time and money. And there is proof. Over 2,800 peer-reviewed scientific publications have used Cytek's technology. This isn't marketing hype, it's literally validated by the science community. So how do these guys make money? Because again, this is really, really important. Anytime you want to invest in a stock, you need to understand how they make money. What's their revenue stream? Well, first, they sell the machines. Right? That's sort of obvious. These are big ticket items, 200, 300,000, maybe $500,000 per machine. They've installed about 3,500 of these machines globally. They added 160 just in the last quarter. But the good stuff is number 2. Once they sell your machine, you need ongoing stuff. Chemicals for every test, service contracts, and maintenance and support, and software subscriptions as a cloud-based analysis software. Now, this is predictable, recurring, high-margin revenue, and it grows over time the more machines you sell. So in the last quarter, service revenue went up 19% year over year. Reagent revenue, basically chemicals, 21% year over year. That's the highest growth they've ever seen. And that's literally the only number I'm watching here. Instrument sales can be lumpy, depends on one customer, their budgets or whatever. But the recurring revenue is steady, it's predictable, it's growth. Now you might be asking, are they profitable? No, not yet on a GAAP basis, which is sort of the Charlie Munger gold standard. They had a loss of $6 million in 2024. But, and this is important, they're moving in the right direction. Wall Street tends to ignore loss-making companies. I like looking for companies that are about to break even because that's typically when things become attractive. Think of Palantir when it was losing money and then became profitable, or SoFi and many other companies. And their loss in the previous year was 12 million. So it's improved from 12 to 6. And in the last quarter, they actually had a profit just for that quarter, not yet for the year. So they're on a path to profitability. They're not there yet, so it's still risky. But there's a reason. The stock chart looks like this is in Trade Vision here, software that I co-founded. And what do you see? Well, you see a stock that's down from 2021 by about 83%. Right? So don't buy and hold individual stocks. That's always bad advice in my humble opinion. But what I do see here, and if you guys join me on Saturday for the live training, you'll learn a lot more about this. You essentially see a pretty long heartbeat pattern here. Sorry, drawing with a mouse. And you have that top here, right? And what do you see then here? Well, it breaks out, and it breaks out with a nice big gap up and a huge increase in volume, which typically means institutional money is pouring in on this. So it's the sweet spot. Is it too late? Not in my humble opinion. Now, I'd like to see this break out above $5. Again, this is not me telling you to buy it. I'm just saying this is the way I look at it. You can come to your own research conclusions, and please, please, please learn how to set a stop before you ever buy something like this, because biotech stocks are volatile, right? This thing is down 80%. But it also gives us an opportunity. And one of the reasons all these biotech stocks are down so much, by the way, is because interest rates went up, and biotech stocks hate higher interest rates. But if we just recovered, a bit, say back to, $15 halfway mark, well, we have a potential 200% upside. That's one of the reasons I like looking at these things, because they have a skewed risk and upside potential, in my humble opinion. And I do have a stop on absolutely every single stock that I have in my portfolio. But there is another reason I like these guys. The opportunity is big. Their competitors are enormous. You're talking companies that are 100 to 300 times their size. So why do I like that? How do they compete? Well, it's the classic David Goliath kind of setup. The smaller companies that are focused typically move faster. They typically innovate faster than the big guys. These guys have 43 patents protecting their core technology. And as I say, they're usually more nimble than the giants. So I like to go for the guys who are really focused on doing one thing really, really well, rather than someone who does 35 things all right. So if we recap this, Cytek is a tech leader in spectral flow cytometry. Say that 3 times really, really quickly. They're basically building a recurring revenue flywheel. right? So they're improving profitability. They're taking share from the giants in specific applications. So to me, the bull case is the industry is growing. It's growing very nicely, 7 to 13% per year over the next 10 years. That's the forecast. So they don't have to be perfect. They just have to be like nearer the top of the industry and not screw things up. And they're going to grow with the market. And if you compound at that rate, you typically get very, very nice results. Now, the valuation is interesting because they trade at about 3 times price to sale ratio. The healthcare sector overall is closer to 4. So there's about a 20% discount here to the sector, which is what I like. And it's down about 80% from its highs. They're sitting on cash. They're not going to run out of it. So that cash, by the way, is worth $2 a share. It's just to you're basically buying the business for $2.79 per share. I'm not telling you to buy it, obviously. And the recurring revenue is accelerating. And there's one thing that Wall Street loves, it's recurring revenue. That's really what it's all about. Get the recurring revenue up the way they were, 19, 20%. And the more machines they sell, the faster it's going to grow. So it's a razor and blades business model. You buy razors probably, right? The razor is almost free, but the blades are it's like buying gold. So you sell the machine, you make money on the consumables forever. It's the same model. Printers is the same model. Many, many industries like that, and it's very, very successful as a business model. And there is another little bonus here, and that's that the European business, the Asian business, they've been weak, but they're coming out of it, I think. US government spending on these machines has been down. There've been cuts on this. So again, when everyone else says, it's bad, well, that's kind of when it's interesting to look at. And we look at the stock chart, money's just starting to flow back in. So when Europe recovers, it will eventually, that upside will be another catalyst. And to me, the path to profitability is very, very clear here. They've cut their net loss in half. Adjusted EBITDA is already positive and growing. Gross margins are now healthy, around 59%. 60% is the gold standard in my book. So they're just going to keep growing the recurring revenue, and their margins are going to improve, and the profitability will be there within, in my humble opinion, a year or two. So that's one of the reasons I like it. Now, the number 6 reason I like it, always a very important thing to look at. I think most people overlook this. Management. The CEO and co-founder, he owns 4% of the company. The CTO owns almost 5% of the company. These guys founded that company in 1992, and they own about 10% of this business. So they're not hired guns collecting paychecks, they're building for themselves. And that's very, very important. And yes, they're actually buying back stocks. So it's quite rare to find a company in this biotech space that's actually buying back its own shares. $50 million buyback program is authorized. And it's because they say, look, the stock's at near a 3-year low. We've got cash, we don't need it. So management clearly thinks it's undervalued. So that's basically the thesis here. And maybe take a screenshot of what I've got on the screen here. And then all I'd say to you is, thank you for watching. Don't rely on people on YouTube or anywhere on social media to find your stocks, because it's a dangerous game, because you don't fully understand why, you don't fully understand their process. You don't have the same risk management that I have. So what I would say to you is come and learn the system and the rules and the process. It's much easier than you think. I'll teach you an enormous part of it on Saturday if you join me at felixprehn.org/training, and I wish you great success. The last time this pattern happened, a lot of people became millionaires while everybody else laughed at them. In the 1990s, people said the internet would never work. In the early 2000s, they said nobody would ever buy things